Hello, and welcome back to the Wealth Management Invest podcast. I am your host, David Bodamer, with the wealthmanagement.com editorial team, where I focus on investments coverage. For this episode, we have with us Todd Schlanger, who is Senior Investment Strategist, Multi-Asset Investing at Vanguard. So I'm looking very forward to picking his brain a bit. So Todd, welcome to the podcast.
Thanks for having me, David.
So before we get going, before I start firing some questions at you, just wanted to give you a chance to talk about what you do.
Sure. So I've been with Vanguard for 20 years as of 2 weeks ago. Past 15 years, I've worked in what's called our investment strategy group, which is you could think of it almost as our centralized investment research group that has many different teams in it. The team that I've been associated with most of that time is the asset allocation team, where we really do research on portfolio construction, multi-asset investing. We also manage, model portfolios for various intermediary clients. About half the time I've been in the group, I've actually worked abroad in our UK and Canadian offices as we launched those businesses, and they needed somebody to help build up the investment library and capabilities for those regions. And before I joined ISG, I worked in our institutional business as part of the outsourced CIO business. So the day-to-day for me is really around research, creating various portfolios for different things, whether it's intermediary clients or even some products that our research gets fed into. And then, of course, doing ambassadorship, going out and sharing our ideas with clients.
Well, congratulations on the anniversary. And yeah, so that gives us a great place to start. I'm particularly curious about asset allocation, and especially if there are any really meaningful shifts happening these days. I mean, we've had this ongoing conversation for the past few years about the 60-40 portfolio. Are there other models? How do you incorporate alts into that, which is a whole separate piece? But just maybe even start from like the highest level of like, where are we at with that kind of allocation?
Sure. So, I mean, as we think about portfolio construction, we have a whole framework as far as, first starting with the investor's goals. Of course, there's no one size fits all portfolio.
Right.
The 60-40 portfolio, it's often referenced for a number of different reasons. It's that broadly diversified portfolio that probably on average represents investors. But of course, you could have younger investors that might be much more equity heavy or more conservative investors that would be more allocated to fixed income. And our view on that, which is one of the strategies that we cover within our team, is that has been a great long-term strategy for investors. It's done well historically. Ironically, right about the time it was declared dead, around 2022, was actually when the outlook for the strategy was improving. Because if you had looked back over the previous decade, it was an environment where we had low fixed income yields,
Right.
and then of course we had though a bull market in equities. And so overall, the strategy delivered more or less average returns compared to its longer term history, but the outlook was looking increasingly low because you had, again, low bond yields and increasing equity valuations, which weighed down on the equity outlook. So ironically, after 2022, when you saw fixed income yields rising at the same time that equity valuations were falling, the outlook was actually improving. So we wrote a blog about that. That's a strategy we feel like is kind of one of those all-weather strategies. We call it the market cap weighted strategy. So if you're holding a broadly diversified basket of both U.S. and international global, equities and fixed income, we think that can be a great strategy for investors. but it's just one of the strategies we offer. We also have models that are more tailored to clients who want to use active strategies, or as you
Hmm.
say, in some cases, they want to use alternative strategies. How you might approach portfolio construction could be different. And then, of course, we have life cycle goals like retirement, college savings, or saving for a home, where there's kind of that, terminal portfolio value that you're trying to achieve to fund something. And then other goals, which we consider, generally wealth accumulation, sustainable income, risk hedging. Overall, there's 13 different strategies that we cover on our team. And again, it starts with the investor and what they're trying to accomplish, what might be right for them.
Right. You always have to start with the goals and their financial position and their risk tolerance. Like, there's never one size fits all, right? It's always got to be very tied to a client and what, what they're trying to achieve.
Absolutely.
So we think, are there newer strategies or newer mixes or newer trends that that are emerging in some of these, options?
Yeah, it's a great question. I mean, over the past, I'd say 5 years, we've just had more and more demand for those non-market cap weighted strategies. So, if you were to look by AUM at our model portfolio business, for example, still the lion's share of the assets would be in the market cap weighted strategies that we've offered for over a decade. But increasingly, we're offering active passive solutions and even dynamic strategies that change with our market and economic outlook. I would say Vanguard's invested, pretty significantly over the last 5 years in really ramping up our capabilities around multi-asset investing, and we now have, like I said, many different methodologies that we use. I would say where we're seeing the most growth would be around our dynamic strategies, where we have our, market and economic outlook, and as part of that, we have capital market assumptions for, over 100 different asset classes that we can then use in our models to help inform asset allocation. So that could be in a equity bond type multi-asset portfolio, or even over the past few years, we've been developing fixed income only portfolios
Hmm.
that change their composition as if they're part of a broader multi-asset strategy. So let's say an advisor has an equity portfolio they're happy with, and they want to pair that with a fixed income portfolio. We have different model portfolios that can kind of plug in there and evolve as the markets evolve, keeping into consideration how those fixed income assets are interacting with an equity portfolio.
And are the model portfolio is built predominantly with ETFs, or is it a mix of fund types that go into building the models?
Yeah, so as far as ETFs, I mean, generally that's been the structure of choice for advisors, due to a number of reasons. So you have the low cost, diversification. You have, of course, many different, or almost an infinite number of passive options, but increasingly, even a number of active strategies can be packaged in an ETF. There can be some tax advantages and, liquidity, flexibility. So I would say, you know, not exclusively ETFs, but I would say the lion's share of our portfolios do come in the ETF structure, because that is where, advisors are preferring to invest within that structure. I mean, ETFs are really funds that trade on an exchange, so there's, more similarities than differences with traditional mutual funds.
Right.
But at the margin, we see the preference for the ETF, particularly among advisors.
Yeah, that definitely seen a lot of data on that, and certainly from both surveys and just data, you can definitely see that the real prevalence. Although have seen some data that shows there is even some variety among how much different shops are using ETFs than others. There's an interesting blend in. It's not a universal situation where they're all necessarily using the same level of ETFs, but it's definitely where things have been trending. And you mentioned another. I, idea I'm interested in, which is just like the continued development of the active ETF space. And there's by launch volume, by the number of funds launched, I'm pretty sure that the majority, this year have been active strategies. I think by, if you just look at the overall ETF universe, obviously the volume is still heavily more passive than active, although active continues to grow. But just seems like there's just a lot of innovation occurring, and I know that's even something that Vanguard's been rolling out active strategies across different things. So if you just want to talk about maybe a little more about what the whole evolution of the active part of things.
Sure. So, I'm more on the multi-asset
Mm-hmm.
side than the product development side. But, the way that I would view that is just kind of a natural evolution of, as we see again, the ETFs being the structure of choice. And they're, as you start to build out, or as, Vanguard and other firms have built out the passive universe over the last decade or so, just naturally, you know, continuing that evolution into putting different active structures within the ETF. And so, yeah, I would just see that as kind of a natural evolution there as that structure and industry matures.
So in terms of the getting back to the portfolio construction theme, are there things happening in the market right now that are affecting how people are allocating? Like if they're changing their mixes at all, or changing asset types, especially as we're sitting at the possibility of the Fed lowering interest rates. We're have this overhang of the question of how much tariffs are going to affect the economy long term. Is that Are those kind of things then filtering down into how folks are making their allocation decisions?
Yeah, so certainly within our dynamic strategies, all that would impact our outlook for the market. Now we use 10-year projections
Mm-hmm.
in our strategies, so that's where we like to differentiate our strategies from, let's say, something that's a little bit more tactical or looking kind of 6 months or a year ahead. In that, if it's very hard to predict what's going to happen in the short run, but if you look over longer periods, like 10 years, for example, there is a pretty strong relationship between the initial conditions or valuations of stocks and bonds and their realized returns. And so, we think that can be informative. Now, we have a time varying strategy that we've been publishing on our website that takes a 60/40, getting back to the idea of how markets are evolving and the 60/40, where just really as an informational exercise and a hypothetical, what we did is took a 60/40 portfolio and we calibrated it using equilibrium assumptions for the market. So in this kind of environment, assume that, for example, equities and fixed income would be perfectly valued relative to their fundamentals. And we said, okay, in that kind of environment, we'll identify the risk tolerance of a 60/40 investor. Now let's plug in today's capital market assumptions where you have actually remarkably normal or expectations for the bond market, where pretty much bond returns are more or less in line with what you would assume in those equilibrium assumptions. And then plug in also our equity assumptions, and not just broad equity, but also within sub asset classes. And what you see there is the portfolio turned out in our most recent update. This was as of the second quarter. It only had 30% in equities. It was
Hmm.
tilted to value over growth, developed markets over emerging, and also tilted to small caps where
Hmm.
valuations were more attractive. Now, when you kind of map that over to our model portfolio business, we don't fully implement that kind of change within the models that we manage. We only allow the portfolio to de-risk by 5%
Okay.
because we know that advisors like to control, the equity bond mix and most of the asset allocation decision based on their relationship and knowledge of what their clients trying to accomplish. However, we do publish the unconstrained, as I said, because a lot of advisors find it useful to know, okay, what is the pure model answer? And then there's different ways that could be implemented. Now, most investors will not fully de-risk to that extent, or make that kind of change. We're not suggesting that at all. But it's more just something that maybe advisors can use as part of their process to see what the model would imply, and then what that might mean for their asset allocation or their client's asset allocation.
Interesting. And you said that this model is updated like quarterly?
Yeah, we update it quarterly, and we publish it on our website. I can include the link if you'd like, but we
Yeah.
include it with things like the expected return, expected volatility, expected or potential for drawdown within the portfolio. And what you see, an easy way to explain why the portfolio is positioned the way it is there was a very small equity risk premium. It was actually slightly negative for US equities at the end of the second quarter. And if you have two assets with very similar returns, but one has greater potential for drawdown, then it would make sense to overweight the lower risk asset. So what you see is that the expected returns of the two portfolios were very similar, but the volatility and potential for drawdown were much less. So that's really the intuition of why that asset allocation turned out the way it did.
Hmm. And so you said the pure model is just kind of giving these readings, but then and you use that to inform, but you're not necessarily making these or wide adjustments because of the what you talked about in terms of like financial advisor expectations and what they want to be able to do.
Yeah, absolutely. We have more, we call it constrained versions, where we're
Mm-hmm.
more constraining the ability of the model to allocate. And of course, directionally, it's going to be very similar, but the magnitude will be less and more in line with what we found advisors are looking for.
And do you have a lot of direct? Are you talking out there with advisors on a regular basis as well?
So myself, more on the research and asset allocation side.
Mm-hmm.
I do get out and talk to advisors occasionally, but not as frequently as my colleagues. So we actually have a full team that talks to advisors about our model portfolio offerings more or less full time. And that's where a lot of the feedback on advisor preferences and expectations kind of comes into our process as part of the model portfolio design process.
Is it a lot of? I mean, I imagine there's just a lot. Just given Vanguard, given the name and the track record, there's probably a lot of advisors that are just reaching out on a regular basis. Is it, or do you also are doing? Is the team also doing some proactive reaching out as well?
Yeah, I think it's a mix of both, where we have, of course, full-time sales executives out there talking with advisors on a regular basis, and then we have, as I said, the model portfolio
Mm-hmm.
team that is kind of specialized around creating and managing different offers for model portfolios for the intermediary business. That's in the U.S. It's kind of structured that way, and then
Mm-hmm.
we also manage models, actually many models in Latin America and Europe as well.
And in terms of, I think you said right now there's about 13 strategies.
Yeah, so there's 13 different strategies that we think could be useful for investors, and what we try and do is create almost a menu of options,
Mm-hmm.
and then for each specific methodology, we'll tend to have, it'll have its own methodology document and white paper typically and things like that. So just to go through a few of them, you have a market cap strategy where you're just invested in broad market, low cost index funds. You have, model driven, meaning we have a tool we call the Vanguard Asset Allocation Model, which is a quantitative portfolio construction engine that run most of our other strategies, and that can use long term long-term expectations for the market for an investor who wants to create a strategic portfolio. In other words, they want to optimize a portfolio to meet a certain objective over the long run and rebalance to that target. So we have, those types of strategies. We have the time varying or dynamic strategies we talked about. We have active passive strategies where we're combining active and passive and even, making trade-offs among different active investments as far as for a certain active risk budget where you get the most bang for your buck. We also have volatility targeting portfolios, return targeting. So, for example, if an investor is trying to achieve a certain real or nominal return target, we have strategies built around that. And we even have strategies that look at things like alternative investments and some of the challenges around lower levels of liquidity
Hmm.
and how you might think about building a broader multi-asset strategy around a private asset, where, of course, it requires a few more assumptions. You have to get an idea of what the range of cash flows into the strategy could be, or potential capital calls and redemptions and things like that, and then taking that into consideration within our model. So those are just a few I mentioned.
Hmm.
We feel like across the 13 different strategies, we can cater to a range of investor needs.
And how often are you going back and like assessing whether you may need to add an additional? I mean, how long has it been those 13? I guess would be one question. And then how is it a process that you revisit on any cadence to sort of see like, oh, maybe we need to add a new mix because we're hearing certain things from advisors or something like that?
No, I mean, I think there's different variations. So for
Hmm.
example, within the active passive, that's a broad bucket. You could have active passive where you're pairing active managers together, or where they're so in other words, if you're investing in US equity, you might invest part of the active allocation in a value manager and a growth manager, or you might, allow those two portfolios to independently, or those two managers to independently optimize within the portfolio. That comes to mind. Also, I mentioned within fixed income, different types of active passive solutions, whether you're talking about, where you're including, let's say, a broad market kind of core active fund, or are you considering something more specialized like high yield or emerging markets? So I would say within each of the 13, there's
Hmm.
also many different variations of how a portfolio could be constructed.
Got it. So, like, are these then like customized for each advisor group rather than just like a pure off the shelf set of portfolios?
So it can be.
It
So
can be.
we
Okay.
we create often what we call paper model portfolios, where we create the strategy and it kind of lives on paper. There are also opportunities often to place our models on platforms like the InvestNet platform,
Hmm.
or even big broker dealers that will come to us and say that they're interested in having one of our strategies on their platform, and we'll develop a customized strategy specifically for them, with their requirements, what kind of funds they want to use, and so forth.
Got it. And in terms of like investors, being in these, I assume, there's the idea is aligning the client's goals and putting them in this portfolio and it being a long-term thing. These are not things that people should be like kind of like bouncing in and out of.
Yeah, absolutely. I mean, if you think about our approach to investing, generally we say, have a clear goal, build a balanced, diversified portfolio, and that's really where we come in, trying to apply, our best thinking as far as how to construct that portfolio. Of course, do it at a low cost,
Mhm.
but fourthly, and can also be one of the most important things, is the discipline of sticking with the strategy over time. So absolutely, most of these strategies, even the dynamic strategies that change, with market conditions, they are intended to be held generally for 10 years or more.
Yeah, often hear from advisors one of the biggest, parts of their jobs are preventing clients from like making panic moves. Like you come up with we have the discussion, we have the goals, we have the plan, and this is the plan, and like don't overreact to something. Don't overreact to markets.
And it's a great point because that's often one of the ways that advisors can really help their clients.
Right.
And why, frankly, why many of them are using and leveraging models is, as the investment portfolio becomes, more and more commoditized within the market, and there's so many more needs for advisors to help their clients with financial planning, with estate planning, and importantly, what we call behavioral coaching, which is
Mm-hmm.
really keeping clients focused on their goals. And, a lot of that is proactive, where, if there's a lot of volatility and drawdown in the market and a client calls wanting to make a change, that could be a difficult conversation. But if you had, kind of prepared them for that inevitability, because of course the market will go through volatile periods.
Right.
Preparing them for that ahead of time is one of the most important things advisors can do.
Yeah. Yeah. Keeping in mind that the long term horizon is the goal, and not overreacting to just you know. I mean, I think we've had some periods where there has been lower volatility that maybe also lull people, but some volatility comes back, and you have to just be able to talk about that and prepare people. And I mean, ideally, you've had the whole idea is like having the conversation, setting the goals, figuring out how everything aligned, and then sticking to it.
Yeah, exactly. And that when you hit that volatile patch in the market, that it's part of the process. It's part of the
Right.
plan. I think can be really important. We have a whole framework around how advisors can help structure their value proposition, and we call it the Advisor Alpha framework that one of my old bosses developed, Frank Canary. And behavioral coaching, that framework suggests that advisors can add up to 3% in return or value to clients, and about half of that comes from behavioral coaching. Other things like tax location, rebalancing, using low cost investments, setting that asset allocation to the client's goals. All those things also can help investors tremendously.
Taking a good chunk of your time here, so I think probably a good point to wrap up. But before we go, I think we will have any relevant links in the show notes. Some of the stuff that was referenced here, anything that's publicly available, should be in the show notes on the episode. But if folks also just want more information, if they're interested in the themes that you've talked about, or reaching you, or reading any of this stuff, where can they go?
Yeah, Vanguard.com, I would say, is a great place where we have there's a whole research and education section that often has our our different papers and articles and commentaries. So that's probably the best place to start.
Well, Todd, thank you so much for your time, and thanks for coming on the podcast.
Yeah, thank you so much for having us.
All right, David, thank you both so much. David, how can people get in touch with you if they would like to ask you some more questions?
Best way is to follow on LinkedIn. So we post all these episodes, and can you also connect with me there, as well as reading our ongoing coverage of investments on wealthmanagement.com in the investment section.
All right. Well, thank you again. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.